It's a nervous laugh. I'm not laughing. So whatever you guys think that I can do, whatever you guys think that I can do to help, let me know. Mireia is a resource. She's always here. She pretty much knows everything there is to know for title. Um, whatever resource we can provide you guys, etc. Please make sure that you guys are referring our title partners. That's what helps us keep the lights on in our office. Any questions on or from the training that we did last time on the comprehensive compensation agreement? All good, right? Okay. So today we're going to cover what it takes to buy a condo in South Florida. A lot of regulations have changed. A lot of laws went into effect when it comes to budgets, inspections, etc. So, anyone have a condo listing right now? Condo listing? Good. Yeah, I mean, we've all pretty much we have to have done condos if we're going to be in real estate in South Florida. It's a must, right? So it's important that we know that we keep up to date with all of the regulations, what's required for contracts, what we can do for financing, how we can help our sellers, protect our buyers, help our buyers, etc. Okay. We've gone into details, into pretty extensive detail before on how to identify what a condo is versus a townhouse. Okay. So that's step number one. Make sure that when you guys are looking at a property, that it's an actual townhouse or a condo versus or vice versa, right? We mentioned that going into IMAP or Realist, something like that, and looking at the current property use code is the best way to identify what that property is currently considered. The way it looks doesn't matter. It can look like a townhouse. It can look like a single family. Here in South Florida, we even have detached condos. So they look like single family residences, but they're actually condos. Okay? Yes. Question? So the difference between a condo and a townhouse is a townhouse, you own the land. So it's your lot. You have a homeowners association, okay? Because you own the lot. Okay? When it's a condo, you own what's within the walls, right? Miramar and Pembroke Pines are very, very common for having properties that look like townhouses, like two-story townhouses, but they're actually condos. Yeah. So why that matters is, aside from regulations and laws, different things apply, your client does not own the land. They own whatever's within the walls.
Okay. Are you also looking at Broward County Appraisal's website for?
That's usually where you start. Where you start is on the legal description, right? You do not go off of whatever the realtor put on the listing. Yeah, and remember, whatever's on the listing is estimate for entertainment purposes only. It's up to us to verify the information on there, okay? So you start with the legal description of the property. If it says lot X, block X, you know that property is on that lot and block. So therefore, they own the lot and the block, right? So they own it.
On IMAP, where did we see that?
I'll show you afterwards. Yeah, because we've covered this before, so I don't want to kind of go into that now. But I'll show you in a particular property. So make sure that you guys know that you're looking at a condo versus a townhouse, because then at that point, the condo rider applies. Make sure you guys, condo rider A as an apple.
Hey, Mono, real quick.
Yeah.
Can you explain with financing why it's so important to check that too with
Yeah.
prospective buyers?
So why don't you explain it, Dom?
Yeah.
You guys know Dominic, my right hand. Come on up. Hey, Dominic.
So Mario's point. Oh, he needs one right there. Yeah, you got it. Awesome. To Mario's point on the checking the use code, ensuring that it is a condominium, it makes the world of difference to us mortgage brokers, because then your buyer will be able to differentiate whether your buyer is going to qualify with a 5% down payment, lot and block townhouse, or if it is governed by a condominium, we're going to have to do a little bit of extra digging, a little bit of due diligence on our end to ensure that we can do a 5% down payment, because if it is a condominium, then we'll have to go, you know how it is, 25% down for most of the associations here in South Florida. Now, we do have a few that are fully approved, which would mean that your buyers can do 5% down. Obviously, 25% down for any type of purchase price is quite a bit of funds that most first-time buyers looking for those condominiums may not have. And then we'll obviously touch on that today, different financing options to be able to do 10% down, 25% down, whatever it may be. But that's the importance there. Do you have something?
Now that the condo has reserve, because they require reserve every condo, it doesn't change the down payment.
So the reserve that's required is not, and we'll go over that in a little bit. It's not the required reserves is for the maintenance due to the inspections that are required every 30 years or every 25 years, every 10 years, and so forth, right? So it's not, it doesn't necessarily mean that the condo is going to qualify or that it'll have enough reserves to meet the 10% requirement as per Fannie Mae, right? The main thing is, if it's a townhouse, we know we can do pretty much any kind of financing, VA, FHA, conventional. It's like a single family residence. If it's a condo, not only does the client and the buyer have to qualify, but also the condo has to qualify.
And most, 25% most.
For your typical mainstream bank, 25%, we can do it, and we'll get into that. I guess we can get into it now.
It's a little
We can,
off the top, what if there's a special assessment?
yeah, that's different. So for condo financing, and it's important that you guys keep in mind, your typical mainstream bank is going to require 25% down so that they can do what's called a limited review questionnaire or a limited review of the condo finances and so forth. This limited review bypasses the 10% requirement for reserves, which was your question, right? So if you have a client or a listing and you want to bypass the requirement for having reserves, the way you do it is with 25% down, right? Now, we have another option, which is we can do a limited review condo purchase with 10% down. Okay, not everyone qualifies. You got to have at least 680 credit. You got to have good income, etc. But essentially, it brings more buyers to the table because you're no longer required to do 25%. We can do 10%. Okay. The way we do it is with a first mortgage of 75%, right? So the client gives, hypothetically, 25% down. So you have a first mortgage of 25%, but then we come in and we do a second mortgage for 15%. Okay. So instead of the client having to give 25% down, they only had to give 10% down. Okay. And they essentially could buy almost any condo in South Florida because we now can do a limited review. We can bypass the 10% requirement as per Fannie Mae. And all we have to verify is that they've done the necessary inspections. They've gone through the insurances, etc. Right. So now we don't care about their budget. We're still looking at the inspections. We're still looking at the insurances and so forth. But it'll bring a lot more options to your clients than just having to give 25% down.
So, what about rental restrictions? Because sometimes when the buildings have a lot of renters, then buyers are denied the loan.
Yeah.
Even if sometimes they require 30% down.
So
if there's too many renters.
So the question is, what happens if there's too many renters in the building? It doesn't matter if your client is buying it as a primary residence, at least not for us. So the rental ratio doesn't matter to us if it's a primary residence. It only matters if they're buying it as an investment. It's on the condo questionnaire. The association has to complete it. And then there they'll say how many units are for rent. Right? So they'll say there's 100 units in the building, there's 70 units for rent.
No, I mean, like, how would they know that it's gonna be my primary?
You have
I
to
can
tell
just
them.
say, yeah, but I can say whatever I want and then just.
You
like,
can-
6 months down.
You can identify as a primary residence.
Yeah.
Yeah, you can do that.
You can do that.
Yeah, you can lie, that's what I'm saying.
I didn't say that. It's up to you.
No, I know.
Off
And
record.
my question is, on the two mortgages that you're getting, the 75 and the 15, do you get the same interest rate on both? Or
No, the second, and here's the cool thing. The second mortgage is actually a home equity line of credit. So the client comes in with a HELOC. Yeah. Right? So if you were to finance, think about if you were to finance 90%, right? Just 10% down, conventional 90%. You now have that first mortgage, but you also have mortgage insurance because you didn't give 25% down. The way we do it is Fannie Mae, the conventional loan, is as if the client gave 25% down. So there is no mortgage insurance. So you now have the HELOC as a second payment, but the total payment is often the same or less than if you would have financed at 90% with mortgage insurance and a lower rate. So the HELOC does carry a higher interest rate. Okay, it's important that you guys know that, but it really doesn't matter. The rate is whatever the market rate is at the time. It's variable. It's typically a 30-year loan. You can pay it down usually at any time. And it adjusts as you pay down the principal balance, then your payment goes down. So once your client pays off this HELOC is revolving. So now they can use it again. They don't have to go to a bank. They don't have to come to us to do another loan application, do another HELOC. It's already there. It's reusable.
HELOC rates are adjustable.
Not all, but yeah, normally they're adjustable. They're not all adjustable. We do have products that the HELOCs are fixed. And we have what's called.
So Dominic, the idea to this, it's like most of these 10%, 25, are they fixed HELOCs?
So just for a quick example on that, with the HELOC being adjustable or fixed. Now, what Mario said, you have an option. There are some banks that do a piggyback, which is what he's referencing, the 15% second mortgage of the HELOC, where they can offer them fixed or variable. Now, just for an example, not to get too personal, but I actually ended up purchasing a condominium that did not have the 10% allocated to reserves. So I had to come in with 25% down. I didn't want to do 25% down. I wanted to do 10. So I decided to do the piggyback. I decided to do the 15%. Now, to Mario's point, you get to pay down that principal as it comes in. It is variable. My interest is variable. Now, obviously with the elections and how the Fed has come down quarter of a point, half of a point, I'm actually seeing a decrease in monthly payments, whereas a couple months ago I was seeing just a slight increase with maybe a quarter increase, a half an increase to the Fed's interest rate. But like Mario said, it's revolving. So once I pay that principal down, I'm now able to access that 15% of my home's equity and utilize that as a HELOC. I don't have to go back to my mortgage lender, my mortgage broker, and say, hey, I need a HELOC. I actually have it set. And whatever you don't use, obviously you don't have to pay interest on it. So it's a huge plus.
Think about it like a credit card, right? If you take out a second mortgage for $50,000 and you've been paying it down, you can reuse it. Just like a credit card, it's revolving, right? So key takeaways from there. If you're listing a condo and it doesn't have reserves, just know that we can offer your potential buyers 10% down, limited review. Okay, it's really important. It brings a lot more options to the table, and your pool of buyers is significantly bigger than if you require 25% down. So keep that in mind.
Just a quick question.
Yep.
So this 10 plus 15%, which is 25%, this is a 30-year mortgage financing.
Yeah, it's your typical like standard HELOC. It's a 30-year. You have a 10-year draw period. So the first 10 years you can access the line. So if you pay it down, you can reuse it. Then the last 10 years it goes into what's called the repayment penalty, repayment period, and at which point whatever balance you owe, then it gets amortized over the 20 years. It's a very simple product, but keep that in mind. It'll bring a lot more options to the table for you.
Can you refinance the HELOC at any time during the life of the loan?
So as mortgage brokers, that's actually a sale point for us, to a point where if we do sell these loans, right, with a HELOC and a piggyback, we do give them the option. Hey, in a year from now, if your equity does go up, come back to us. If you don't like the HELOC option, but you really do like that property, that unit, we can always refinance you out of the HELOC and get you into a 30-year. We don't necessarily, because once it comes to a refinance, maybe you will have the 25% equity. So you can just proceed with a limited review and then cancel out the HELOC. Now you're into a 30-year regular mortgage.
But Louis, honestly, we just don't refinance those HELOCs. It's such a good product. Once you pay it down, you can just leave it there. If you don't owe anything, you don't pay interest.
My concern for the clients is that interest rates go up for 2 years, 3 years. Right now, things are going down, favorable for a HELOC. But if they go up, then you're either paying more interest.
You mind if I touch on it?
Correct. Yeah. Yeah. Go ahead.
So there's always going to be a cap, right? And we fully disclose the cap. So that interest rate's going to have a cap on it. It can't exceed, let's say, 12%. If we get it at a 9%, it can't exceed. There's going to be a threshold there. There's going to be a floor. There's also going to be a cap. And now another thing is we don't want the interest rate to increase for our borrowers, right? A good thing for us, the conversation that we have, because we've written these loans, tons of them, to be able to get borrowers into that unit that they desire. Pay down that principal. Be sure that you're doing your due diligence. Make sure you keep an eye on that principal. Pay it down when you have those, some excess funds. And on top of that, like Mario said, we don't necessarily want to refinance those borrowers out of it because it is such a good tool. So these are for the more financially savvy clients that say, you know what, it is good. If the rate does go up, you can also utilize the other, rebuttal. It always can go down. And right now we're seeing a very favorable market with the Fed. They are decreasing interest rates. So you could go with the negative, but we also like to lead with the positive. You do have a chance, and we fully disclose that options to the borrowers. That interest payment can go up, but it also can go down, which is a huge benefit, especially in today's economy.
Yeah. Thank you, Dom. So we'll move on. We'll go over the condo rider now, and we'll just kind of add in what's required, what's needed, what changed, etc. Are you guys aware of the December 31st deadline that's coming up? Of what regulations going to be put into place?
Everyone has to pay reserves. All reserves have to be.
Yeah, in short, yes. Everyone has to. So what you're referring to is the structural integrity reserve study. And if we look on your condo rider, and it's page 3, number 10, A, B, and C. Condo rider, page 3, number 10. So the new law mandates the creation of a public database. Oh no, that's something additional that's going to come in. Is a public database for condominiums. That's also coming in now, right? So the new law mandates the creation of public database, or the DBPR. This database will keep records of all residential condos in the state of Florida that are 3 stories or higher.
For owners to know, or for the public,
It's gonna be public. I think that's good. I don't know how well it's going to be maintained and how often it's going to be updated and things like that. It's yet to be determined. But the idea behind it seems to make sense. Okay. Now, we have an approved condo list that we can provide our agents and our team. So we actually have compiled a list of condos that have qualified for full financing and limited review financing that we can provide to you guys, so that you're not showing your clients condos that don't qualify, and you're not wasting anybody's time. Okay, so we actually have a list already. Right now, this list that they're coming up with, the public database, this is going to be essentially all of the condos. The list that we give you is just the approved condos, so you guys are not wasting your time, right? So if we pre-qualify a client for a condo purchase and they're looking in, I don't know, Sunrise, and the condo is not on our approved list, just don't show it. It's going to be very likely going to be a waste of time. That condo is not going to qualify, right? We also have a second layer of verification once we run DU, right? That we can verify if the condo is on any blacklist or anything like that. So at the point of pre-qualification, that we're able to pull the client's credit, verify all of the income, etc., we can run DU and verify if a condo is on a blacklist or anything like that. Okay. So in other words, this list is going to be public, but we actually have a list that confirms that condos qualify for financing, so that you're not having to sort through all of this data.
Itching transaction desk?
No. We have it.
Oh, yeah, we have it.
Yeah, it's tedious to put together, but We have it.
Okay,
We
so
have it.
we put it together.
Yeah, yeah, and we provide it to essentially, if we pre-qualify a client for condos, like we'll give you the list, right? Like we don't want you guys to waste time. Nobody, the client wants to find a condo, we want you to find a condo, and everybody wins.
We would have to ask you guys for the list, because you can't access it.
You can't. No, that list is you can't access it. No.
Proprietary, Mario.
Look,
Only
man.
kidding.
I would say too, another, point on that list, we do like to update it every month, every 2 weeks, whenever we do see that other condos are getting approved through Fannie and Freddie. So if we do send out the list after the training and you guys maybe don't see a condominium on that list, feel free to just call me, call Mario. I can always look up the list and run it because it does get updated because more and more loans are getting written for these condominiums.
So the way we do it is in our lenders, as they approve a condo and they review the whole thing, they'll approve a condo and they'll put it down as approved. We grab it from there. So now we create our list from that list of lenders. That's essentially what we do, right? Because once the condo is approved by the lender, they don't need to reapprove it again. We can go through underwriting very smoothly. It's already passed pretty much all of the hurdles that it needs to be approved, and it's a smooth process from there. Okay. So December 31st is going to be the deadline for reserves. And that's a structural integrity reserve study. The primary purpose of the study is to ensure the longevity and safety of condo buildings by planning for future repairs and establishing a financially sound reserve fund. Condominiums associations can avoid sudden large assessments on owners and ensure compliance with safety standards. At least that's the idea. So what do you guys think will happen now that all of these condos are required to have a reserve fund for all of the items that are coming up for maintenance, anything that comes up during the 40-year, 30-year inspections? How do you guys think that's going to affect our market?
A lot of people are having to sell.
I'm sorry?
A lot of people are having to sell because they can't cover those costs.
Could be.
It's already happening. People are trying to get rid of
Mhm.
Yeah, could be.
But I think more, because the reserves are gonna be, up to date, more condos will get approved, right? Wouldn't that happen from the lender?
In my opinion, the idea behind this, so condos have always had a history of mismanagement of funds, right? That's usually like the biggest hurdle we have is these associations grabbing these funds and mismanaging them. I don't think that fixes it. You're still going to have mismanagement of funds from these HOAs, from these condo associations. This doesn't fix that.
So it might create a problem with the supply of available.
What I think this will do, once you go through the milestone inspections and they say you need to, change the roof, X, then the associations will have, let's say, $100,000 to budget. Then they'll do a special assessment. They'll start collecting on that, and then that'll be the reserve fund for the milestone inspections and to fix those items. The rest of the association items are still being managed as they were before. And if they were mismanaged before, chances are it's going to continue to be mismanaged. I think it's going to change. I don't think it's for the best.
Do you think it's gonna affect the qualification of a buyer after December 31st deadline? Like, they have to get more money possible.
Not necessarily the buyer, maybe. I mean, if there's a special assessment, yeah, maybe.
Well, even these funds that have to now be funded by the owner.
You got to have a reserve fund. That's why you do the reserve study, right? So the reserve study says you need to fix or maintain these items within X amount of years. It's going to cost you X amount. So monthly, you have to save this amount so that when the time comes, you have enough in the reserve funds to be able to pay for roofing, plumbing, painting, etc. Right? Electrical. Now, again, that doesn't fix the problem of mismanagement of funds.
I don't know why they don't regulate the HOA board more, so they're more qualified to
That should-
manage these funds.
that should probably be a thing. A lot of these condo associations, there's no checks and balances. That essentially they do whatever they want to do, and you know how South Florida how South Florida is.
So if a condo has not passed their 40 years, because I had a client looking in Olympus on Wellington Beach,
Okay.
you know, and the 40-year was done on one building, but they had two other buildings that weren't complete, so the buyer couldn't get financing.
Yeah, correct. So if in Barbara's question is, if the 40-year inspection, there's 3 buildings in the association, one of the buildings passed, the other 2 are still pending.
They're still working on it,
Right.
So they turned down the whole deal.
So if they haven't passed the inspections, you're not going to be able to get financing unless you do something, a different type of loan that's not conventional or FHA or anything like that. It's called
they just
non-QM.
Oh.
You may be able to do it. It depends. Okay. So what we would do, something like that is, we would look at the building out of the 3. Is your client buying in the building that has already completed?
Yeah, the building he was gonna buy in was completed, but they were all under one property manager. So
Yeah.
because of that, he couldn't buy at all.
Yeah. If he's doing a conventional financing, right, which he was, he's not going to be able to do it. You have to do something different. Non-QM may be the solution. So typically it's not like Fannie Mae or Freddie Mac, like a bank statement program, for example. It's different set of underwritings.
But the higher interest rate would be higher.
Yes and no, right? It depends, because if that's the only loan that they qualify for, then essentially the rate doesn't matter. As long as the payment makes sense, should be fine. As long as they can get financing, right? Then at that point, it's up to the client whether they want to take on the risk of buying in that association, knowing that only one of the 3 has completed the inspection. And if, let's say, for example, where I've seen is the association budgeted to complete all of the repairs, but the first tower took up more than the budgeted amount. You now have a shortage to complete the other
Now
2.
they're gonna bill everybody.
Now there's an extra special assessment coming, right? So that may be, and everybody has to pay. It's not like you fix mine and I'm done. It's everyone is in on it. But something like that could be case by case, where if it all makes sense and the budgets make sense and the building, we get an engineer to sign off that the building is safe and sound, et cetera, it may work. But you can't do it conventional. You can't do it conventional. So this new law applies essentially the requirement of reserves. Any building that's 2 stories or higher, you have to have this reserve study done by December 31st of this year. And then every 10 years thereafter, the reserve study needs to be done. That goes alongside your milestone inspections, which you have a 30-year inspections, used to be a 40-year, so 30-year inspections now, or 25 years if you are within 3 miles of the coastline. So if you're near the coast, it's every 25 years, not every 30. And then every 10 years thereafter.
Where is it?
Oh, these are in my notes. No, these are in my notes.
Is it 5 years near the coast?
No, I have 3 years. I have
I thought you said 5 years for near the coast.
I have 10.
So then what's the?
And I just pulled this I verified this before coming on here.
Okay, so it's 10 years the coast and then 30 years and 30.
No, it's 25 years
To the
if
coast.
you're within.
So then what's?
And then every 10 years, and then every 5 years thereafter.
Can you, Mario, can you repeat that? I don't know what it is.
Yeah, guys,
So what is it?
guys, hang on. Stay with me. If you are within 3 miles of the coast,
3 miles, okay.
25 years is the inspection required.
25 years?
25,
25-year inspection required
yes.
for the 3 miles from the coast.
3 miles from the coast.
And then every 10 years.
And then every 5 years thereafter, if you're within 3 miles. If you're not within 3 miles,
It's 10.
then it's 10. Okay? And it's the same thing for the reserve study. So think about, you have your inspections. Your milestone inspections tell you everything that the building needs to be updated or fixed, maintained, etc. And alongside that comes your reserve study. That reserve study is essentially a budget for your inspection. That's simplest form. Okay.
The problem right now with the building started in this year is the assessment is only going directly to the 4 years of inspection or for report from the building, but not going through the the research. That's the problem next year.
That is a problem.
Probably the condominium is gonna be up, the association gonna be too.
And you have increased insurance costs. You have increased flood costs,
Yeah.
et cetera, et cetera. Yeah.
Well, because the
I know.
people is only taking care of the steel of the building, how the building looks, what's the problem.
From
Yeah.
experience, the
Yeah.
condos that qualify for full financing typically tend to have less risk of something like that happening. Right.
Because they only taking care of the building, the state of the building, how it is looked, what the inspection.
Yeah, no, look, it's
every-
funds mismanagement by the
Yeah.
associations. The best thing you can do for your client is find a building that qualifies for full review
Yeah.
Fannie Mae, because then at that point, not only do you and your client scrutinize the budget and the insurance, but also the lender. So it lowers the risk. It doesn't mean that there's always risk. It may happen, but at the very least, we can verify that the budget seems to make sense, insurances are correct, etc. Right?
And the insurance, it's many things that happen in the buildings. And then probably next year, I think it's gonna be many of the owners of the condos that we have short sales or foreclosure.
I don't know about short sales because there's a lot of equities.
Foreclosure.
I don't think foreclosures either. There's a lot of equities. There's a lot of equity in properties.
Okay.
So
Now that's-
there's a lot of equity in properties. I don't think there'll be foreclosures, but there'll definitely be discounted sales. There'll definitely be discounted sales because there may be an increase in the supply for condos, right? There may be. Yep.
In terms of opportunities for the reserve requirement going forward, the two types of, the short-term view and then the long-term view. In the short term, obviously the assessments are going to increase. Just wanted to ask your opinion. The assessments are going to increase the HOA fees, right? So a lot of owners are going to be sitting on those fees, and it may cause a lot of them to sell, right? So obviously we can grab that market share and attempt to list maybe to some cash buyers, investors, whoever it may be that can afford that payment. And then in the long term, do you think that with this reserve requirement being structural, the repairs will be made maybe within 3 to 5 years? We'll see some increase in the condominium values
Yeah.
with this requirement.
Yeah,
Obviously, it's kind of a benefit, right?
That's a good point. And for you guys as realtors, targeting these owners may be a good opportunity for you in terms of creating new listings, right? Just if an owner, they can no longer afford the increased fees, or maybe the rent is no longer covering the total cost, it may make sense for them to list. So it may be an opportunity for you guys to target these owners that may want to get rid of these condos. I think in the long run, history shows us that the values of properties will just continue to steadily increase. That's just what it is. Maybe in the short run we have a little bit of a shock beginning of next year once all of these fees kind of like start kicking in. But medium to long term, I think it's just going to go up.
Because like you said, a lot of these owners are sitting on equity. So if they do sit on the equity and they want to pay off the assessments, those pending assessments that populate now within the next year and year thereafter, they'll be able to, then we can pick up those listings because of the increased market share.
Exactly.
Try to sell them, attempt to sell them, and then the prospecting would also be to get those sellers into single family homes.
Yep. And now you guys know what's required from you as a listing agent to be able to sell these properties and stay compliant, stay within the laws, etc. Right? Any questions there? So next we're going. I want to touch on very quick condominium rider. Go back to page 1, number 2. The right of first refusal. We went in depth into this a couple of trainings ago. as to what the right of first refusal is for the association. Make sure that you guys are selecting whether the association has or does not have the right of first refusal. You cannot leave it blank. A and B is specifically, right? So A says the association has the right of first refusal. B says the association members have the right of first refusal. Okay? Yeah. So for those of you that don't know what the right of first refusal is, some associations, as defined in the condo bylaws, etc., regulations, say that if someone puts up a property for sale and they get an offer on said property, the association has the right to review that offer and match it and buy that property before they sell it to someone else. Okay? Really important that you guys look through your condo bylaws anytime you get a listing in a condo. You need to know this. Secondly, you need to know if the association doesn't have the right of first refusal. You need to know if the members have the right. So for example, if you list a property for sale, you get an offer, and the association doesn't have the right, but the members do. Now the other owners get to say, yes, I want to buy that property before you sell it to someone else. Hence the right of first refusal. Okay? We went into depth on that last time, so I don't want to get too much sidetracked there, but it's important that you guys know that.
So once you get an offer, you should really ask the board or find out.
Only if they have the right of first refusal.
Or member.
I think
That first.
But they have to match the offers.
they have to match it. So, yeah, they have to match it. Okay?
Rare. It's rare case.
Second page, letter C, same paragraph. Or I guess number 3, letter C. Special assessments. Seller represents that seller is not aware of any special or other assessment that have been levied by the association or that has been, and this is really important here. Page 2, C. Special assessments and prorations. You see it? Or other assessments that have been levied by association or that has been an item on an agenda or reported in the minutes of the association within 12 months prior to the effective date.
So even if it was an item but wasn't taxed?
Even if it was an item, you have to disclose it. Okay? So,
I have a client.
yeah.
When I sold the property, the seller said that there was no assessment, the association said that there was no assessment, but 3 months later, it comes $16,000 assessment.
So, what I would do, I would ask for the meeting minutes over the past 15 months, so you can look back the 12 plus the 3 that you've owned it, and see when that special assessment was added to the meeting minutes.
Is this new or?
Okay, and what you can do, who's going to pay if the seller already left and
Stuff. You know, it's something that should be addressed before closing, because after closing, you now have to seek legal counsel. There's added fees, etc. For $6,000, it's going to be tough. 16,000,
Wow.
and the seller's now. It's going to be tough.
You know, but a lot of times when you look at these condos, the docs are attached. And if the docs are not attached to your listing, if you go to a closed listing or another listing in the same building, someone has it attached. I always call the HOA myself. I never trust the seller. And before my buyer was gonna put in an offer, I found out that there is an assessment coming 9 months from now. It was discussed, but not in the minutes, but it was something that I was able to tell my
Yeah.
buyer.
Well, you're a good agent. Not everyone does that.
Research, right. So
Not everyone does that.
Put in the title company.
No, this is not title companies, not their responsibility.
It's the agent.
So same page, number 5, the last paragraph. Same page, number 5, the last paragraph. This agreement is voidable, and it gives you a list of documents that we need from the seller in order to stay compliant and protect the transaction. If you're on the seller side, If you take on a listing, we need to collect these documents well before we go into contract. Do not wait to go into contract to start collecting these documents. The list is there in the last paragraph. So you need your declaration of condos, the articles of incorporation, bylaws and rules and regulations, condo docs, essentially.
Last page, what item is that?
Yeah, it's the last page here.
Got it, Bob?
Page, no,
Page 2.
go back, page 2. There.
Right.
There. If you read through that, it itemizes these documents for you, right? So bylaws and regulations, copy of the most recent annual financial statement. That is not a budget, it's a financial statement.
Yeah, different.
Currently approved annual budget. And something that's not here, but you should be collecting, is the proposed budget. Right? We're getting around that time of the year that budgets are expiring and you need to start collecting next year's budget, depending on when the associations close out the year. It is usually around the end of the year that they start working on the next year's budget. So make sure that not only you collect the approved budget, collect the proposed budget also. And disclose it, if you're on the list side, disclose it to the buyer. Just send everything all together to the buyer. You also need to ask for the frequently asked questions and answers. Some older associations are not going to have this.
So we need to check out the B.
So, well, the B says this contract is voidable, but you need to provide all of these documents. The buyer needs to review and approve them, and within 3 days, sign off that they are approving. Okay? If you give it to them up front, then you don't select B, you select A, because A says you've already given it to them and they've accepted it. Okay? So if you're on the buy side, you don't want A selected. Even if you're a good agent like Barbara and she does the legwork and she collects everything, don't tell the list side that you have these documents.
Oh, no.
Because if for whatever reason something happens and you need to get out of the contract, you can still get out with provision B because you haven't been given these documents from the seller. Okay? What's the question?
If I'm representing the buyer, I choose A. If I'm representing
You choose A, they give you all of the documents and you review them and you accept them.
A or B.
Now B says, so B, you submit your offer and in negotiation it gets approved, etc. Everything gets signed, but you still haven't received the documents you need.
Right.
Okay? You have 3 days to review all of these documents. Now, if you are on the list side, I would add the 12 months meeting minutes,
2 months.
meeting minutes from the association, and the proposed annual budget for the coming year. On the list side, it's our number one job to protect the transaction, make sure that we sell and we don't give the buyer any outs of the contract.
Mario, real quick.
Yeah.
To what Barbara stated as well, on the MLS, how it allows you to attach the condominium documents. As soon as we get a condo list, if we ever do get a condo listing, the first thing we like to do, immediately call, email blast the association. Some of these management companies are super hard to get used to, to reach. I think as soon as you get one, just wait to upload it to the MLS. If you're on the list side, and then upload all of those documents onto the MLS. Let the agent know, hey, your documents are on the MLS. I can email them for you, pull them if you would like. That way, when they send you over the condominium rider, all you have to do is if they select B, you can mark it off and then maybe counter it and put A because you already have all of those documents. You can cross that off your list and then you can go through without the buyer, like Mario said, being able to find that way out in the case that maybe financing declines, something happens.
So you start collecting these documents the moment you get your listing signed. Don't wait for a contract to then try to figure out the rest, okay? The moment you get your listing, you're asking the seller for copies of the or contact info for the association, emails, phone numbers, etc., and you just start harassing them for these documents. Okay? Don't wait. You I would also add a third item, which is the master insurance policies for the buildings. The master insurance. So that's not, the three that I added were the meeting minutes, 12 meeting minutes, the proposed budget, and the master insurances. That's not here on B. Okay? So as a listing agent, I don't have to, I am not required to provide these documents to the buyer. But if I do it, there is no question about whether I didn't disclose something properly. Like, there's no argument. Everything was disclosed. You signed off on it. Like, you checked it. There's no reason for us to have even an argument that something was not disclosed. Everything's here.
And you know what, too, also the HOA payment coupon amount.
Yes.
They need to verify that.
That would be,
because
well, yeah, yes.
a lot of them don't even
Yeah,
put
yeah,
the HOA
Yeah,
amount,
correct.
and they know it's higher, so they don't
That's a
put it.
good point.
So
That's a good point.
get verification of whatever the HOA payment is. The idea is, if you're on the list side, we're not giving any kind of outs or a reason or a way to get out for the buyer. We need to protect our client, the seller. Okay? If I'm on the buy side, I'm not asking for anything. Right? If I'm on the buy side, I'm waiting. Right? Because I know I can get the budget, I can go to the association and grab it. During the interview and the reapplication, I can ask for the master insurance. Like, I can get the majority of these documents. Declaration of condos, they're public. I can pull them from public record, right? But if for whatever reason the transaction goes south and I need to get out of the transaction, and the inspection period has passed, the financing has passed, everything has passed, and they still haven't given me the documents, I can get out. Well, that wasn't this.
So is there a verification of receipt of documents?
You gotta have it
Page
signed.
3. Page 3, number 6. Make sure that you are, as the buyer, you put in requests. Number 6, page 3.
What are you saying, sir?
Make sure that your buyer requests these documents. Number 7 is the receipt, buyer's receipt of documents. So as the listing agent, you have to get this signed by the buyer. This essentially says that I provided all of these documents, you reviewed them, you had enough time, and you accept the documents as they are. Again, there's protect the transaction, the buyer. I mean, nobody wins if we fall out of contract. So the idea is, we, as the seller's agent, we need to protect the seller, provide everything. On the buyer side, don't rush to grab everything because it gives you a way out. You have to know your client. If your client absolutely wants this property, then it probably doesn't matter. If your client is between properties and they're not sure, and you're not sure of, the rental income, the appraisal, et cetera, you may not want to rush the listing agent to give you these documents, as it protects your buyer.
I know you said that it should be done when you get the listing, but sometimes you can't get these documents from the HOA. Is there a timetable when you have to furnish this to the buyer?
So if I'm the buyer and you have a condo listing and you've been trying to get these documents from the HOA for a month, I can get out of the contract at any time.
Yeah, but you can also do an
Right.
addendum, right? They
An
can-
ad-
you
an
can
addendum
do it
too?
To extend the time if you gotta get them, right?
If you're, yes, technically, but again, there's no deadline for me to get them other than before closing. But if you don't get them, you're essentially leaving the transaction up. Like, it's at risk of being canceled at any point.
So you have up until closing to get these documents?
You need to get these documents right away.
By the way, but if you can't, you have up until closing?
Technically, the buyer has 3 days to review these documents and decide whether they approve them or not.
3 days.
Get out.
Yeah.
They can get out.
You have to do your due diligence and try to get- I know there's HOAs that, they don't furnish these things by the way.
Yeah, the moment we get a listing or anyone on our team, start hounding the association for these documents. where are these documents? I need them. Until otherwise. Sometimes they'll reply and say there is no frequently asked questions, for example. We don't have a proposed budget yet. That's fine, right? When I'm sending it to the buyer, I'm telling them there is no proposed budget. Like I'm putting that in. No proposed budget yet. No frequently asked questions, etc., etc. Make sure you sign off and that they accept the receipt of documents. That closes their out. Okay.
I remember my long time ago, you have to have all the. You remember? I don't know how long.
You always, I
really
mean, as far
Yeah.
back as I can remember, I've been doing this since 2006.
Yeah, but.
Been a long time.
It was so strict. You have everything.
As far back as I can remember, the list wasn't so long, but we've always needed to provide
You have to
disclosures
run,
for
you
this.
have to run to find the whole document and the whole,
Yeah, you-
everything.
As a good agent, you
before,
have to. You have to protect the
Yeah.
transaction. I mean,
Yeah.
you don't know, right? What could happen? Look, if you close and everyone's happy, it doesn't matter. It don't matter if it starts going south and they get attorneys involved
So they're looking for a way out.
and they're looking for a way out and you just gave them one and your client, your seller finds out that you handed it to him on a silver platter, you're gonna have a problem.
Another good thing is showing up to the management's office, their physical office. It's not on site to the listing, the condominium itself, but showing up, being in person, asking for the documents, not leaving until you get them. That works as well. We've done that 2 or 3 times, and it's
Yeah,
been
I
a
do that-
hassle.
I
But
do that too.
yeah, it's
I go
just
there to get the documents. I take my client's HOA application. I want to get a face to a name. And I've had so many transactions that close earlier and they're approved right away.
Yeah.
Just by greeting the person I'm
Yeah.
dealing with.
absolutely.
I take my HOA application.
And maybe
I don't
some
care- I don't
coffee
care
and
what
donuts. Look, for financing, we have, as per the as-is contract, I have 5 days to submit a loan application. I need the budget, I need the master insurance, like I need those things to be able to submit the application and go through the condo approval process and get you guys to closing quickly. If I don't have a budget and no master insurance, and it's been 3 weeks and you're closing in 2 days and you're calling me to close, what am I supposed
You
to
lost
do?
your time.
So if you have this up front, you as the listing agent, I'm giving it buyer, broker, here's the master, here's this, here's that, whatever you need. I don't want there to be any delays. I don't want there to be any questions, right? Same thing on the buy side. At the very least, if the listing agent is not giving you the budget or the master insurance, you can usually get it from the association by submitting your application. Okay? So just get your buyer's application ready, walk it over and say, I need the master insurances, I need the budget, get it in your email, send it to us, and then that way we can submit for financing. Any questions, comments?
I think the last one of the other docs, the pivotal doc, is the condo questionnaire.
Oh, yes,
The condo
condo questionnaire, thank you. In addition to your master insurance and your budget, we're going to need for financing a condo questionnaire. There's 2 types of questionnaires. There's a full review questionnaire. We look at everything there's to look at for financing. A little bit more tedious. There's more hurdles to cross. It's technically safer for your client because the bank is really scrutinizing the budgets, the insurances, and so forth. But not a lot of condos qualify for a full review. If you know upfront the condo doesn't qualify for full review, then we need to do what's called a limited review condo. So we have full review, you have limited review. Okay? Limited review, most mainstream banks will require 25% down. We can do it with just 10% down. So keep that in mind. If you have a listing that doesn't have reviews, reserves, reviews. I know. So if a condo does not have reserves and it's your listing, any agent that comes through to show your client, their clients, any clients that you show, etc., put us in contact with them because we may be able to finance this condo at 10% down, and it'll give you guys significantly more options, a bigger pool of buyers to offer these listings to. And then thirdly, the option of doing no questionnaire. This is when we go the non-QM route. When we do something, that's not Fannie Mae conventional, et cetera, FHA, we just do something like a bank statement program, something like that. Or we do like a foreign national investment or just a purely investment loan, then the questionnaires become significantly simpler. We always look at insurance. It's case by case, but the insurance requirements are less strict. Right? So just because you don't have, or another lender turned down a loan, or you think you don't have reserves, et cetera, let us take a look at it because we may have an option for your client. Questions?
That's a big thing with the insurance, the master insurance policies. A lot of the condominiums may be missing, let's say, wind and hail. I'd say flood. All of those will definitely get you out of conventional financing. The banks will deny it. So we've had a case where realtors have brought us maybe about 4 times this year their condo questionnaires from different lenders. Hey, can you do anything with this? Our client really wants to purchase. Let us know. Like Mario said, the non-QM route, the best route we can go. The condo questionnaire usually is about 4 or 5 pages long. With the non-QM route, it's only 2 pages. They're asking very general questions. To Barbara's point, interest rate may be a little bit higher, but it's always worth comparing. And if your buyer really wants it, we can definitely get you guys to closing with that route as well.
What if
that
it's an
program.
investment property too, for condo?
Same thing.
Same thing?
Yeah.
But isn't the down payment more if it's an investment property?
Technically, you can do down to 15% on an investment. However, the pricing makes it impossible.
Yeah.
So that way, this started probably around 2020, late 2020s or so. The investment market for like 15% down, they started charging like 7, 8, 9 points to do something like that. So it just becomes undoable. So technically, yes, Fannie Mae can do a 15% down, but the cost is too much and it doesn't make sense. So now you shift over to 20% down. So 20% down investment still requires a full review.
So like, what's 30%? Is it 30% that requires no limited review?
If it's an investment,
Yeah,
30% is the requirement.
30%.
And that's really important. So I guess it's worth mentioning the 10% that we can do as limited review for Fannie Mae, for condos, it has to be a primary residence. It cannot be investment.
Right.
If it's investment, then it's 30% or 25% with a second mortgage. Yeah.
So on the investment question, we actually have a deal right now where we're doing an investment purchase, and it is a condominium in Miami-Dade. Limited review, we're actually able to do 25% with this specific lender, and it is a condo, no reserves, but we're still able to do 25%. So we have that option.
Yeah.
So most of the time, most lenders require 30%, to Mario's point, if it is an investment and it is a condo, but we do have an option to do 25% down investment and a condo and limited review. So you get the best of all 3
Yep.
worlds, essentially.
And now everybody is required to have flood insurance.
Well, that's always been that. If you're in a flood zone, Florida law requires the association. If you're in a flood zone, you got to have flood insurance.
They let you know now that everybody in Florida requires a flood insurance.
If I don't see it in the legal from Florida Realtors, I don't know. So keep an eye on it. If that's the case and you see a legal update,
Applying for impact windows in the city of Pennsylvania.
okay?
And they called me and said that I have to send the flood insurance. I explained that I am not in a flood zone.
Yeah.
They told me that the new regulation is that everybody in Florida has to have a flood insurance.
Ask them for the regulation
Right.
and send it to me. I haven't heard of that. If you're in a flood zone, yes, you have to. But now,
That's why they said we are not in a flood zone.
no, that doesn't sound right.
I don't have flood.
Especially, look, think about it, especially if you're in a building, in a condo, you can't get flood insurance
That's why I said.
because it's the condo. You can get content insurance, an HO6 policy that covers the inside of your unit, but you can't get a flood policy for the building that's not your building. It has to be in the master if you're in a flood zone, yes.
No individual.
Exactly. Yeah, because it's a condo and you don't own the structure anyway.
Because doesn't explain that.
Ask them for the
That's our
regulation.
manager.
Okay.
Yeah, it doesn't sound right at all. All right, questions, comments? See you guys 2 weeks, November 26th for Turkey Day.
All right.
All right, guys.